Most people believe credit decisions are based on what is true today. But lending systems do not evaluate a single moment. They evaluate movement. Timing is not just about when something happens. It is about how quickly it happens and how often. Layer 3, timing and velocity, measures change across time because change carries signal. If Layer 1 asks, "How do you behave?" and Layer 2 asks, "How is your structure built?" Layer 3 asks, "How fast is it shifting?" Speed matters in risk modeling. Slow, steady progression communicates stability. Rapid shifts communicate uncertainty. Imagine two borrowers. Both increase their credit utilization from 10% to 40%. One does it gradually over 12 months. The other does it in 2 weeks. The structural position may look identical, but the timing signal is different. Rapid change increases interpretive sensitivity, not because growth is negative, but because acceleration increases unpredictability. Lending systems are designed to detect acceleration. Application timing works the same way. One inquiry every 12 months suggests deliberate planning. 5 inquiries within 10 days suggests urgency. Urgency is not automatically risk, but clustered activity triggers interpretive tightening. Timing interacts with perception. A new account opened after years of stability is interpreted differently than multiple accounts opened simultaneously. Velocity influences weighting. The system does not only record events, it measures density. How concentrated are events within a defined window? Clustering compresses time, and compressed time increases scrutiny. Now consider recovery. Someone misses a payment, then restores stability. If the recovery is followed by months of uninterrupted consistency, confidence gradually rebuilds. But if recovery is followed by rapid new applications, new balances, and new structural shifts, the system interprets instability, not because recovery failed, but because the profile continues moving quickly. Layer 3 measures movement rate. Movement rate influences predictive modeling. Slow, controlled evolution communicates management. Rapid fluctuation communicates volatility. Volatility increases modeled uncertainty, and uncertainty influences approval thresholds. Another example: 2 borrowers reduce high utilization balances. One reduces balances steadily across 6 months. The other makes a dramatic paydown days before applying for credit. Both improve their structural ratios, but the timing signal differs. Sudden shifts near an application window can be interpreted as reactive. Gradual improvement appears sustained. This does not mean strategy is punished. It means velocity is observed. Lending systems are built to evaluate patterns over time, not snapshots. Timing also affects how long stability has been established. 12 months of consistency carries different weight than 3 months. 3 years carries more weight than 1. Duration builds predictive confidence. Layer 3 connects time and probability, because probability strengthens through repetition across uninterrupted windows. When timing is stable, The system relaxes interpretive intensity. When timing is compressed, it increases scrutiny. Again, this is not moral judgment. It is statistical modeling. The system asks, is this profile evolving gradually, or is it shifting rapidly? Rapid shifts are not always negative, but they are always measured. Layer 3 explains why someone can improve their profile and still experience hesitation in approval decisions. Because improvement occurred quickly, and quick movement reduces historical depth. Depth requires time. Confidence compounds slowly. Velocity compresses observation. Now connect this to the larger framework. Layer 1 defines behavior. Layer 2 defines structure. Layer 3 defines change. Change rate influences how behavior and structure are interpreted. Slow, consistent timing strengthens classification. Rapid, concentrated timing introduces variability, and variability increases modeled exposure. Understanding timing and velocity removes confusion. It explains why spacing applications matters, why gradual balance reduction matters, why sustained stability matters. The system rewards controlled evolution, not sudden transformation. Because lending is forward-looking, and forward-looking models rely on temporal stability. Timing is not a detail. It is a layer, and that layer shapes how every other signal is weighted. In the next episode, we will examine risk interpretation, where behavior, structure, and timing combine into one approval probability model.